Hello everyone. Today we are going to discuss about the topic portfolio management. Before understanding what is a portfolio management is, we need to know what is a portfolio. A portfolio is nothing but a basket or a single screen which shows multiple security assets of an investor. Security assets include stocks, bonds, money market instruments, cash equivalents, commodities, closed-end funds, and exchange traded funds, which is shortly known as ETFs. This is just a replica of a company's portfolio, which has the company's investment. Portfolio management. Portfolio management is an activity done by the portfolio manager so that the selected asset or the controllable asset is in his capacity. An investor tend his work of portfolio managing to his portfolio manager so that the portfolio manager calculates all his risks and returns of a particular asset. The investor invests his money into such investment so that the risk is low and the returns are high. Portfolio management, the meaning is the selection, prioritization, and control of an organization's programs and projects in line with its strategic objectives and capacity to deliver the expected returns. Defining portfolio management, it is a collection of wide range of assets that are owned by the investor. The said collection of financial assets may also be valuables ranging from gold, stocks, or any other security asset. This is just a mind map of portfolio management. The investor invests his money into bonds, securities, ETFs, mutual funds, cryptocurrencies, private equity, real estate, precious metals like gold, silver, diamond, etc. A portfolio manager oversees all these activities and suggests if the risk is minimum and the returns are high. These are the elements of portfolio management: asset allocation, diversification, rebalancing. Asset allocation involves spreading the investor's money among different assets classes so that the risk of the given asset is reduced and the returns are increased vice versa. If the single nature of asset is being holded by an investor, the risk is very high and the returns may get a bad. Diversification. Diversification means completely owning different kinds of assets. There is a saying, never put all eggs in one basket, which means investing a wide range of assets on a single nature may hit the investor on the risk rebalancing. It is an annual process or a periodical process which helps the investor to analyze if the invested goods or the invested assets perform very well. These are the process of portfolio management. Process. The first step is identifying the objective, which proceeds with estimating the capital market and then decision about asset allocation. Fourth one is formulating suitable portfolio strategies, selecting on profitable investments and securities, implementing portfolio, evaluating and revising the portfolio is called as rebalancing. Rebalancing the composition of portfolio. Phase 1. For a capable investment portfolio, investors need to identify suitable objectives which can either stable returns or capital allocation. Here, the risk needs to be lower and the returns needs to be higher. Only by following the news of the particular company, he will be able to understand what the phase is. Second one, to identify the expected returns and associated risks to take necessary steps. Now, he has analyzed what are the risks which are to be known and he will take the necessary steps here. The measures are taken here. Generation of earnings at a minimal risk and sound decision must be made about the suitable ratio on asset counts. Now, as said before, asset allocation is nothing but investing on different nature of assets. Phase 2. Strategies must be developed after factoring in investment horizon and risk exposure, which avoids risk and to engage a flow in the process. Just as the normal course of the business does not get affected by investing in a wrong asset. Profitability of assets is analyzed by factoring in their fundamentals, credibility, liquidity. If the risk is high, the performance of the asset will be low, so that the normal course of the business gets affected, as seen in the phase 4. Phase 5 actually suggests profitability of assets so that the credibility and liquidity is high and can be sold on a benefited way. Phase 6. The planned portfolio is put into action by investing in profitable investment avenues, which means the same that the investor invests his profitable the money into a profitable investment. Phase 7. A portfolio is evaluated and revised regularly to evaluate its efficiency. This is known as portfolio evaluation. Evaluating so that the risk is minimized and the returns get high. If we find any unwanted asset in our portfolio, we will just discharge them. Portfolio's composition is rebalanced frequently to maximize the earnings. This is a periodical process as discussed before. This happens with the portfolio management. As far as portfolio management is concerned, we have two types. One is active investing, another one is passive investing. Active investing requires a hands-on approach, typically by a portfolio manager or other so-called active participation. There needs to be active participation, which means buying and selling of assets in the capital markets on a regular basis. Active investing requires confidence that whoever is managing the portfolio will know exactly the right time to buy or sell. He uses fundamental or technical analysis. Successfully, active investment management requires being right more often than passive investing. Passive investing involves less buying and selling and often results in investors buying index funds or other mutual funds. Here, the participation is very low. Passive investors limit the amount of buying and selling within their portfolios, making this a very cost-effective way to invest. He invests occasionally and beholds it for a long period of time, and then it depends on the holding mentality. Now let's discuss about evolution of portfolio management. Modern portfolio theory, which was established by Harry Markowitz the year 1952. Pharma French theory, which was developed in 1992, is depending upon the size of the firm's book to market values and excess return on the fund. Another evaluation model is endowment model. Endowment model opens to the investment process to the true opportunity set and makes it possible to earn returns from sources that have traditionally been closed to both institutional and individual investors. This is a tabular column which shows the investment study, current investor base, current management providers. Modern portfolio theory, which was developed by Harry Markowitz, is adopted in the 70s, although established in the year 1952. It followed till 80s, and then portfolio factoring happened in 1960s. Then it was adopted in the 80s. Again, endowment theory, which showed ultra high net worth. The role of portfolio management starts with analysis of constraints, ascertaining the risk, drawing a strategy, determining objectives, selection of portfolio, diversification, selection of industries, selection of companies in the industry, determining the size of participation, calculation of expected returns, capital appreciation ratio, actual growth of it. We have certain risk measuring methods. First method is range analysis, standard deviation, coefficient of variation, alpha and beta, R squared, Sharpe ratio. Range analysis is nothing but the difference between the highest value and the lowest value. In a market term, we can say it as optimistic value minus pessimistic value. Standard deviation. It is the most useful in conjunction with an investment's average return to evaluate the dispersion from historical results. Standard deviation is equal to square root of R minus R dash, where R dash is the expected return, whole squared divided by number of returns minus coefficient of variance, where the summation R, which means total of complete returns found divided by the n number of returns, or the expected returns is shown. Coefficient of variation, the ratio of the standard deviation to the mean, and shows the extent of variability in relation to the mean of the population. The higher the CV, the greater the dispersion. If the standard deviation is equal to 0, then the risk is 0. Alpha is a measure of an investment's performance on an adjusted risk basis. It takes the high volatility price risk of a security or fund portfolio and compares its risk adjusted performance to a benchmark index. The excess of return in the investment relative to the return of the benchmark index is alpha. Beta. Beta measures the amount of systematic risk on individual security or sector as related to the entire stock market. Beta is equal to weightage 1 into return 1 plus weightage 2 into return 2 plus weightage 3 plus and so on and so forth. Summation n I is equal to 1 weightage I into return I. R squared is a statistical measure that represents the percentage of a fund portfolio or a securities movement that can be explained by movements in benchmark index. R squared is most useful when attempting to determine why the price of an investment changes. It's a byproduct of a financial model that clarifies what variables determine the outcome of other variables. Sharpe ratio. It was found by William Sharpe to measure investment performance by considering associated risks. For calculating the Sharpe ratio, the risk-free rate of a return is removed from the overall expected return of an investment. The Sharpe ratio is most useful when evaluating differing options. This measurement allows investors to easily understand which companies or industries generate high future returns. This is the process of choosing a portfolio, assessing the current market situation, constructing an optimal portfolio list, evaluating the liquidity, selecting investment options, choosing the risk tolerant, better returns with medium moderate risks. Now, let's discuss about the portfolio management process and fundamental analysis. Portfolio management policies create and maintain a personalized plan for investing. This groups about the investor and portfolio manager that these are the policies which are to be adopted by the time of investment. Selecting a mix of investments as seen in the asset allocation that matches the person's responsibility, objectives, and appetite for risk. Fundamental analysis. Fundamental analysis is a method of determining a stock's real or fair market value. Helps to analyze stocks currently trading at higher prices or lower than their real value. If the fair market value is higher than the market price, the stock is deemed to be undervalued. It depends upon the unfavorable balance of the balance sheet. Fundamental analysis is a method assessing the intrinsic value of stock. We use qualitative and quantitative method for fundamental analysis. Fundamental analysis is when an investor analyzes a company's future profitability based on its business, environment, and financial performance. It depends upon the historical data to check how things were in the past, publicly known information such as the news about the company, including announcements made by the management and what others say about the company. It is a review system. Information that is not known publicly but is useful. How the leadership handles crisis situation. This happens only after the internal check of a company. Steps involved in fundamental analysis. First one is macroeconomic analysis. Economic analysis, industrial analysis, company analysis, financial analysis, valuation. Industrial analysis plus economic analysis plus company analysis is equal to fundamental analysis. Types of fundamental analysis. As said before, first one is qualitative analysis. Qualitative market analysis involves the study of company's goodwill, company behavior, demand, and the internal activities held by a company and company's recognition in broader markets, so as goodwill. It aims to unearth answers to questions like how it is perceived, how management decisions or announcement creates a buzz in the market, and how it's different from its substitute. To choose an extra alternative, we could choose this particular company. In addition, its brand value and other common market factors depict in a socio and economic position in the market. Second one is quantitative analysis. Here, we will analyze the investment and statements of a company. Quantitative analysis is inclined towards statistics, reports, and data, financial statements of a company. It is solely based on its financial statements, quarterly performance, balance sheet, debt, cash flow, etc. It involves analyzing numbers, ratios, and values to understand the price of the shares and the company's overall financial health. Fundamental analysis. Economic analysis plus industrial analysis plus company analysis is equal to fundamental analysis. Economic analysis relates to the analysis of the economy. This relates after in economic analysis and forecasting techniques. This related to the study about the economy in details and analysis whether economic conditions are favorable for the companies to prosper or not. Analysts always try to find out whether the economic development is conducive for the growth of the company. Economic analysis is the process of assessment or examination of any particular topic or issue to understand how they are affecting the organization or system. This process of analysis comprises administering and operationalizing a comprehensive and holistic study of various processes such as production, consumption, consumer behavior, national income, employment, and others. It studies and estimates the topic in detail with all the aspects associated with the industry concerned. These are the methods of economic analysis. First one is deductive method, second one is inductive. Methods of economic analysis. Deductive method. The study starts by assuming factual information of rudimentary facts and then arriving at a concrete result or conclusion by following logical reasoning or analytical abilities. This method, a theory, is built on the basis of certain assumptions and experiments. Can use general assumptions and conclude our analysis with specific objects, which means we can go for general to specific. The common rule to remember in the case of deductive methods is to move from general inputs to a particular assumption and or eventually constructive theories. This is a replica of the steps in deductive method. Next one is inductive method. Analysts or theorists advance from a practical outlook to a scientific problem in order to be more accurate in finding the most accurate solution using theoretical knowledge and practical applications. The induction method is processed in two forms: statistics, experimentation. Statistical value is used through empirical data, experimentation is done through periodical data. This method is basically observed with statistical forms of investigations. It involves a lot of facts, including numbers, quantities, and formalities. This is a mind map of steps included in inductive method. Industry and company analysis. Understanding a company's business and business environment, industry analysis is used in stock selection and valuation as it helps an analyst understand the health of the industry, the issuer's growth, opportunity, and business risk. Industry analysis is useful for understanding a company's business and business environment, identifying active equity investment opportunities, formulating industry or sector preparation strategy, and portfolio performance attributes. Three main approaches to classifying companies are products or services supplied, business cycle sensitivities, and statistical similarities. Company analysis takes place after the analyst has gained on an understanding of the company's external environment and involves answering questions about how the company will respond to the threats and opportunities presented by the external environment. This is happen only in quantitative analysis. This intended response to the individual company's competitive strategy, The analyst should seek to determine whether the strategy is primarily defensive or offensive in nature and how the company intends to implement it. Assessing the economic and financial condition of a given sector of the economy is termed as sector analysis. Company analysis is a process carried out by investor to evaluate securities, collecting info related to the company's profile, products, and services as well as profitability.